I'm so glad to welcome you to the Clank Howard Show, where it's about you learning ways to keep more of what you make. You can follow me at facebook.com/Clank Howard, our web address, clark.com, coming up in 20 minutes. Instead of a Clark-rageous moment, it's time to talk about something that our fellow Americans are doing that is absolutely great, helping each other. There's a lot we can talk about where people are getting up in the morning trying to hurt each other. Let's talk about somebody doing something great. And then a half hour from now, information is power. And until the last couple of years, people didn't want you to have your report card, your dossier on what the banks thought about you, what insurance companies thought about you. But now there's a race to make that information available to you for free. I'm going to tell you more about that in just 30. I'll talk right now about something that you're going to say, huh? This is an issue? And unfortunately, it's an issue for millions and millions and millions of Americans, because even though housing has recovered in so much of the country, there are people still in neighborhoods and zip codes in certain communities in the country where last decade people borrowed on a home mortgage and then borrowed more on HELOCs, home equity lines of credit, and have never been able to refi those. They've been paying on them. But now the number of people that are going into delinquent status is rising significantly this year and is going to go up a lot next year. Why? Because the first 10 years of a home equity line, most lenders make it interest only with teensy tiny payments, with nobody expecting someone to have a HELOC that would go past 10 years. At least that was the thought. But now these people that have been trapped in the HELOCs and the banks that have the borrowers that are in them both face a terrible time together, because now once the 10 years is up, principal is due. There's like 1.5 million people right now in the country that are struggling because they're supposed to pay all these principal payments in addition to interest, and they can't get it done. And next year is going to be another 1 million or so that are going to be in the same situation. What I want you to know is that if you are sitting there with that time clock ticking, don't wait until you're in over your head with it and you can't make a go of it. The lender doesn't want to have you default on that loan. You know why? Because if you default on that home equity line and there's really no equity in the home, the lender loses all its money. So their incentives are aligned exactly with yours. So while you still have good credit and wiggle room, go to your lender, approach your lender, sit down with them and say, what can we do here? I know I'm going to have difficulty making the principal payments when they start in a few months. Hiding from this doesn't solve it. It only makes it more difficult to deal with. So preserve your good credit and keep your home by going to your lender now and see what they might be able to do to work out something for you. All the big lenders have been reporting to the regulators that their delinquencies on these home equity lines are rising. And that's why they're aware, and you know that that time clock's ticking. So go to them and see what you can make happen with some form of the word we haven't used much in recent years, some form of modification. Ellen is with us. Hello, Ellen. How are you?
Clark, hi. How are you?
Great, thank you.
Clark, I wanted to first let you know how everybody really appreciates you, right? Because not everybody thinks logically in a situation that has to do with money. I have just been given a car.
Wow.
Which is wonderful.
That's really nice.
Well, my dad passed away, and my mom
sorry.
doesn't drive anymore. So,
okay.
And it's only got 20,000 miles on it, but it's a bigger car than I normally drive. It only gets 20 miles to the gallon, where my car gets 35 miles to the gallon. And they're both the same manufacturer. It's the kind of family we are. We kept one kind of car the whole time, So I have 66,000 miles on my car. My car is a car payment of $272 per month. Plus, of course, I have to carry the collision insurance on it, which I wouldn't have to do on the other one.
Wow.
What do I do? What do I do? Do I trade them both in for a brand new car practically with no payment at all, or do I let the car company put a little loan against the one I'm being given? What do I do?
There is no one right answer other than the only wrong answer would be to dump both the cars and buy a new one.
That's the wrong answer?
Right.
Okay, that's what the dealership would like me to do.
Of course, because they're trying to generate a transaction and have two used cars that are new enough that they could turn some real money on them on their used car lot.
Oh my goodness!
Now this is kind of like one of those things that would be on a math exam, in terms of all the variables you gave me.
Right.
But the vehicle that I would be most excited about you keeping is the one that doesn't get very good fuel economy, but only has 20,000 miles on it.
Okay.
That your late father's car is virtually a baby at only 20,000 miles.
That's true.
And so if I were looking at this as logically as I could, I would rather see you pay more in fuel. How many miles do you tend to drive a year?
Well, I was driving 85 miles one way to my work and back, but I got fired, so I don't have that job anymore.
Okay.
So I'm going to be driving to my new job, starting a new job on Monday. I'm going to be driving about 30 miles.
One way?
Yes.
Okay, so you're going to drive 300 miles a week, and let's say you're working 50 weeks a year. That's 15,000 miles for work. The vehicle gets 20 miles per gallon. I'm doing this on the fly. That's 750 gallons. Your current vehicle, you said, gets 35 miles per gallon, right?
Yes.
And so that is 430 gallons you would use a year. So the difference between the two, 320, you're talking about $800, let's say, in round figures, difference in fuel. But for a vehicle that has 46,000 lower miles on the odometer.
Right.
So if it were
no way to get out of the loan on the other one, though.
Sorry?
What about the loan on the other car?
Well, how much upside down are you on that one?
A lot. The difference between $5,000, which is what the wholesale value of the car is, maybe retail $8,000 and $12,000, which is what the loan is, which is what it was cost new. So very much has not changed in the 16 months I've had the car. Okay.
Well, the alternative, because you're somewhere between $4,000 and $7,000 upside down on the car,
right,
is you could take out a loan for that amount of money on your late father's car.
Right.
And that would be preferable, in my book, to you selling your dad's car and keeping yours. Now, there is something that's not about dollars and cents, though, that comes into this that we've not talked about at all. Which car do you enjoy driving more?
I've never driven the one I'm being offered.
Go drive it for a few days.
Well, that would be when I pick it up. It's 1,000 miles away from me. I have to fly to go get it.
Well, you get to go see your mom when you do that, right?
Well, I just drove back from seeing there. I drove up and back this past weekend.
I still think it's worth you going and driving it for a few days. Because you're asking me a decision that is a dollars and cents decision,
True.
but ultimately...
I would know better after I drive it back down here.
All right, but driving it back down, what if you drive it back down and you don't like it? You then are you inheriting it and then you can sell it?
Yeah, it's going to be mine.
Okay, so then drive it down, and then based on that, make a decision which way to go. Because if all things being equal, if you like driving both cars, who knows, you might even like your late dad's car more.
Right.
You might even, for sentimental reasons, like driving.
No, isn't that silly? Get attached to that because of
No, that is what humans do. So don't look at that as silly at all. But if it's equal or better than your existing car, then go ahead and sell it at a loss to the loan value. Take out a loan on your late dad's car and drive it because the advantage would go to that. The one thing that would be absolutely a terrible decision, though, financially, is to dump both cars and buy a new one. That is a complete no-go. Even though it might help the car salesman, it does nothing but hurt you. And is it Army?
Yes.
Hi, welcome to the Clank Howard Show. How are you doing?
Thank you, and thank you for taking my call.
My pleasure.
My question is, this friend of mine just told me that they have an investment in a variable life insurance, and we never thought of a life insurance as an investment. I mean, I used to think that it was just a protection. That's my question to you. What do you think of it?
I hate them. I hate them. I hate them. I mean, I was backing up on my heels when you're telling me somebody's saying variable life insurance is an investment. If it's an investment, it's a junk investment.
Okay. All right.
Don't tell your friend I said they're garbage, because if your friend has one and actually believes in it, you don't want to insult your friend.
Okay.
But for you, you just smile and you say, that's just not my kind of thing. This is why you don't do, most often today, it will be a variable universal life. It'll be what they call a VUL. But the idea behind them is that you own investments and life insurance all in one package. The problem with it is that the taxation of it can be bad, but that's not what really worries me. It's the expenses that are embedded in one for commissions and ongoing costs are off the charts gigantic. And so what is the goal you're trying to reach?
We're pretty good with investment. My husband maxed out his 401k, his 457, and I do not work, but we did take out a traditional spousal IRA, and we do invest for the kids, but we have like a little bit of money left that we said, we won't touch, and we want to invest it. Again, we did put it in stocks, we have a little mutual fund, but then my husband doesn't believe in, putting everything in there. He likes little things in different places. Yeah,
that's not the little place I'd try to do things to diversify. I mean, you and your husband are already doing fantastic things. He's doing the 401k, 457, so he's some kind of government employee, I guess?
It's not a government employee. It's private, but they have those, and we took advantage of them.
Okay.
And so far, we've left them there. They've been up and down, but
Yeah, but the key thing is that he's a real big time saver, and so are you. If he's maxing out the 401k, maxing out the 457, you're both doing IRAs. The only annex I'd say to that is I'd prefer that the two of you do Roth accounts instead of IRAs.
Okay, Roth accounts.
And because the difference is with the 457, it's likely pre-tax. With the 401k, it's pre-tax. With the IRAs, you got pre-tax money. I'd rather you do Roths, because with the Roths, the money is after tax. Okay. And so you don't have to worry about that money being taxed again.
So what would I do if I open a Roth? What would I do with that traditional? Just roll it over?
Well, you have a choice. You can take, since you have some extra money right now, you can take your traditional IRA money and move it into a Roth, and then you pay tax on it now, no penalty, but you pay tax on it, and then all that money that was in the IRA, plus whatever money this year and forward you put in a Roth, all is yours tax-free in retirement. So it kind of balances the portfolio where you have the money right now that is pre-tax. It gives you a pre-tax pile of money in retirement and an after-tax pile of money in retirement. And I like that mix. But as for the variable life insurance or variable universal life insurance, I have never seen ever a situation where that would be a good purchase decision as a method of saving or investing. This is the moment on the Clank Howard Show where you're usually hearing a Clark-rageous moment, where somebody has done something really awful. They're taking advantage of you. You might get ripped off. But from time to time, I like to do a Clark rave, where instead of talking about something outrageous, I talk about something fantastic that people are doing or someone is doing to make a difference. One of our staffers on Clark.com was talking about a relative who has been involved in doing something that I was excited about, that a lady is doing in Muncie, Indiana. Read about it in the Muncie Star Press. Janetta Presley set up a blessing box. And it's this wooden box in her front yard, sits on a cinder block, and it's stocked with non-perishable food and toiletries. So has a little sign, says, take what you need, bring what you can. And there's various food products, diapers, shampoo, soap. And so the thought is that if you have a neighbor who's having some difficulty, you're helping them out, no questions asked. And then others wanting to be of help come and replenish, restock the blessing box. This is something that has happened haphazardly in communities around the country. And there are some religious congregations that do their own version of a blessing box, where they have pantries where they provide food to people. And this is a much more small-scale thing than the very, very large food banks that are in operation around the United States. But I love something with minimal bureaucracy, where somebody just sets up this little wooden box and says, take what you need. And isn't that the spirit of giving that we want to see more of? We, the American people, can be so generous and so good to each other. Never forget that.
Rocket Mortgage by Quicken Loans proudly supports this podcast. Rocket Mortgage brings the mortgage approval process into the 21st century. It's fast, powerful, and completely online. You see, Rocket Mortgage has taken all the complicated, time-consuming parts of applying for a mortgage out of the equation. Hate searching through stacks of old files and paperwork? Well, with Rocket Mortgage, you can easily share your bank statements and pay stubs at the touch of a button. It helps you get approved in minutes for a custom mortgage solution that's been tailored to your unique financial situation. Even better, with Rocket Mortgage, you can do all of this on your phone or tablet. It's a quick online process that you can manage from the convenience of your couch. So if you're looking to refinance your mortgage or buy a home, check out Rocket Mortgage today at quickenloans.com/save. That's quickenloans.com/SAVE. Equal housing lender, licensed in all 50 states. NMLSconsumeraccess.org number 3030.
Welcome to the Clank Howard Show, where it's about you learning ways to save more and spend less. And don't let anybody ever rip you off. On the web, we serve you at clark.com, CLARK.com. Got a question for me? clark.com/ask. This is really, really great. I think back over time where no one knew the term credit score. When I'd ask somebody how their credit was, people would say, well, I really don't know. I think it's okay. And lenders would use the secrecy that surrounded your credit scoring to play mind games with you, charge you more, discourage you from shopping around. It was really dirty dealing on the part of the banks to try to get you to pay more than you needed to. But because of the Consumer Financial Protection Bureau, lenders have felt pressured to give you your credit score. And as a result of that, now virtually every major lender in the country makes credit scores available to you for free. It started heavily with credit cards, where on a monthly credit card statement or signing into your credit card account online, you could see your credit score for free. An actual FICO score, which is the one most lenders use. And Wells Fargo has recently gone a step further by allowing people who have a bunch of different types of loans access to credit scores, auto loans, mortgage loans, that kind of thing, where you can see your credit score. Knowledge is power. If you educate yourself, pay attention to that score, know where you rank, you know what you might need to do to improve, you can take that information and put yourself in a better position. It's kind of like what I talk about with retirement. If you don't set goals, you don't get around to doing anything. Well, with credit, if you're not aware of the factors that are holding you back, or even not even aware that you're holding yourself back, that your score is mediocre, knowing what it is, what you need to do to improve it is key. That's why I encourage you so much to sign up at Credit Karma, where you're able to see 2 of your credit scores, not actual FICO, but you get a sense of how you're doing. You get to see those for free, and they tutor you through the process of raising your score. But basically, you don't need a tutor. I'll tell you the 2 things you need to know. You might need a coach, but not a tutor, because the 2 things that really matter are paying every bill every month on time. And I say every, I mean every single bill on time every month. And the second factor that confuses people no end is having low utilization of credit, meaning whatever credit you have, and you add up your credit limits, that you're not using more than 30% of that available credit. There are people who are mistaken and think, hey, I'll close accounts, that'll raise my score. Closing accounts lowers your score because you increase the amount of your available credit you're using. Why is that so big? It's like a third of your credit score. The reason that one's so huge is that statistically, when people use more than a third of their available credit, as you move up from that, people are more and more likely to default on credit or go delinquent on credit. It's just math. And obviously not everybody who's using a big percent of their available credit is going to default. But it's such a strong indicator that that's why it represents, to be exact, 30% of what makes up your credit score. But if you have access to free scores, which almost all of us do now from any financial institution we do business with, pay attention to it and see how it trends over time. When you have a question for me on the Clank Howard Show, go to clarkhoward.com/ask. Hello, John. How are you today?
Hey, Clark. Thanks for taking my call.
Certainly. You have a question that many of us wish we had, and that is a pension that you have to figure out what to do with. Is that right?
That's right. It's not very much, but I did work for a major corporation back from 1998 to 2004. I had a 401k, rolled it over to the new company I went to, but I got some communication from them a couple of weeks ago in the mail about a pension, and addressed me as a pension plan participant. So I called them, and they referred me to the investment company that's kind of managing it for them, and it is one of the ones that you recommend. And I called and talked to them, and they said that I am vested, and I can start receiving my benefit now. I'll be 51 later this year at $91.94 a month for life, or if I waited to age 65, it would be $207.43 a month for life.
So you have a choice of something that's usually referred to as longevity insurance.
Yes.
If you take it now, it's money that's found money to you.
Right.
That you will have for the rest of your life. Does it inflation adjust, or does it stay at the flat amount forever?
They told me these are the amounts. I mean, if I start it now, it's $91.94 a month for life. If I wait to age 65,
it's $207.
Yeah.
So it is normally a better idea to wait the 14 years and take it at age 65. So I say normally, based on lifespans, with you having made it to past 50 years of age, your expected lifespan stretches to somewhere close to 80 years old.
Okay.
So that's why waiting 14 years, which is kind of half that time period, gives you a benefit less than half what you'd get waiting. Because if you think about it, living a normal lifespan, you end up with a similar amount of money. But the difference is that money is much more valuable to you, particularly getting more every month when you're at a point that you're not as likely to be working full time as now.
Right.
And historically, thinking about men in your family, going back one generation, two generations, how long have men tended to stick around on Earth?
My father's still alive, and he's in his mid-70s, and then his father probably passed away when he was in his early 80s.
Okay, that would very much support, you got a good gene pool there, that the odds would favor you waiting to 65 and getting a much larger check.
Okay, that's what I was thinking, because I was like, well, $91, $94 a month now is really not going to help me a whole lot, budgeting around the house, but the $207.43 when I'm around with retirement age seemed like it would be more beneficial, but I wanted to see what you thought.
And your instincts are right on that. Most people do the opposite, though. Most people always take the bird in the hand. They're like, hey, money now? I wasn't expecting money now. I'll take it now and not think about the long term. So Good choice.
Thank you.
Okay. And isn't it nice when there's money you don't know is going to be there and suddenly they say, hey, we got some money for you, and it's not a scam. They mean it. Matt is with us on the Clank Howard Show. Hello, Matt.
Hey, how you doing, Clark?
Great, thank you, Matt. How can I be of service to you?
Well, what I'm asking about is a recommendation on the best roadside assistance plan. I have a couple of kids who are off to college. It's about a 17-hour drive from our home, and so we make a couple of long trips per year. And I feel a little bit more comfortable having some type of a roadside assistance program.
Well, this came up in an ugly way on our show recently. It was something that I had no idea was going on, and that is auto insurers selling roadside assistance as an option. You should never buy. If your auto insurer offers it, don't buy it from them, because some insurers, we don't know how many, are now, if you make a claim for roadside assistance, are treating it as if you had a major auto claim, accident claim, and putting a black mark on your record that makes it hard for you to shop for auto insurance for 5 years. So You want to buy from an independent source. The largest independent source out there remains AAA.
Right, and we've looked at that, and looking at the plan for 3 vehicles that we have, it was a little bit more than what I suspected. I heard of another company that offers a similar plan at a much lower rates, but
is it one of the reimbursement plans?
It works similar to AAA.
Okay, so let me draw a distinction here. AAA, typically you call them, and depending on how busy they are or not busy, you could be waiting 15 minutes to 15 hours for somebody to come, more often 90 minutes or so.
Right.
And it's their own either vehicle or contract vehicle that comes to you. Most other auto services work in a different way, and read closer because this other one may work that way. You pay for your own tow or roadside assistance, and then they reimburse you up to a certain dollar amount for you having done that. And if you found another one that says they actually dispatch vehicles to you, then you may have the same issue that people talk about with AAA, that it could be 15 minutes or 15 hours or who knows where in between.
Right.
So pick your poison, because if you do one where you get reimbursed, you're filling out paperwork you wouldn't have to fill out otherwise.
Okay.
But if this one, how much cheaper, give me the price comparison. How much was AAA for your family where you live versus this other roadside assistance outfit?
Yeah, AAA, round numbers for 3 vehicles, about $160 per year. The other company advertises at $69 per family.
Well, I think you try the $69 one. Your downside is so low that if they turned out to be reliable and dependable, you're saving an enormous amount of money.
Right, but however, looking at the internet, I have seen some bad reviews, so I'm having a difficult time finding.
So that's the downside. You already know that people haven't been happy with them.
There you go.
But with any roadside assistance service, AAA included, if somebody has been stranded by the side of the road for hours, they're not going to be happy no matter what at that point.
Right.
So,
well, interestingly, the bad reviews have been about billing practices, not on the roadside program. So,
all right, I would say that's a deal killer.
Yeah. That's why I'm calling you.
Yeah. So if people are complaining that they're playing games with what they bill you, I think that one's automatically marked off your list. You know, a lot of people have tried to move into this area. Sam's Club tried for a while. If my memory serves me right, Costco did for a while too. But I don't know that either of the warehouse clubs are in that business anymore at all.
Okay.
They may be. I'm just, it's not on my radar. If either, are you a member of Sam's or Costco?
Sam's Club, yes.
So if you go to Sam's Club's website and they have a thing where you can click on services, you'll be able to see if they still offer roadside assistance.
Yeah, it's a good idea. I'll do that.
Is it Joel of our crew says no more. So don't even bother going to look, because he says effective March 31st, 2010. Wow, that's old. Sam's Club will no longer offer a roadside assistance program as a benefit to our members.
Okay.
So, I mean, just like that, we were able to save you wasting time.
Well, thanks a lot, Joel. I appreciate it.
Okay, you take care. Good job, Joel. Eileen is with us, and Eileen, it'd be great if the sun shone just beautifully every day of the year, wouldn't it?
It would.
But you want the sun to be your power plant.
It certainly could help. It seems to go pretty good here some days, and then other days it's not. But they tell me it works even if it's just a little sunny. So,
well, I'm a big fan of solar. We have a solar farm at our house where we have, not on our roof, but on a hillside at our house, we have a massive solar array on stilts. And it's just the best because all those kilowatts the sun is providing for me for free at our house instead of having to pay the power company.
That's what I have heard. It can do that.
How can I be of help? Are you hearing a pitch from somebody about putting solar in at your house?
Well, I actually had somebody come out to the house, and, you know, they, with the Google Earth, they can see your house and figure out exactly if you're in a good spot. And I'm told I have a couple months where I wouldn't be paying anything except the basic fee to the utility company.
That can happen. That is a pretty big promise to make, though.
Yeah, it's just a couple months out of the year.
Okay.
And so it's not, I didn't think it was like overly done. There is always going to be something that I'm paying because they say there's no out-of-pocket expense for me.
Oh, this is one of those lease deals where they lease panels to you?
Yes, I believe that's what they call it.
All right, be very cautious and careful with the lease offers.
Okay.
Because you want to have that as something. I think that those lease offers should be reviewed by a lawyer on your behalf.
Okay.
Because you're committing to, is this a 20-year lease?
Yes.
So if you're looking at signing a 20-year lease, if you intend to sell your home eventually, believe it or not, that solar lease becomes a liability for you selling, not an asset selling.
Yes, he did say something about that it would be passed on to the next owner. However, in our situation, I am more or less sharing. It's my house, but I'm sharing it with my daughter and her husband and grandson.
So they would benefit in decades to come.
Yes.
Okay, and one thing I'll ask you, if you have the money, and I don't know if you do or not, have you considered just buying panels instead of leasing them?
I was kind of surprised about what the guy told me when he came out here for that. I didn't expect that at all.
Yeah, well, they make big money leasing panels to homeowners, but the thing is, that's something you should do if you can't afford to buy the panels. Eileen, if you can afford to buy the panels, if you have the money to do so, don't get into one of these complicated leases. Just flat out buy the panels, and it becomes an asset of the house, not a liability that comes with the house.
You know, when you're going to buy a car, pricing information is great and necessary, but there's more to doing it than just the price. There's the actual buying experience. If you want to enjoy a better one, you should go to a TrueCar certified dealer. They're there to help you find the car that you want, and they're also what make TrueCar unique. With TrueCar, you can connect with a local certified dealer that you choose, so you can lock in a guaranteed savings off the MSRP and enjoy a totally better buying experience. And by better, they also mean faster. Over 2 million cars have already been sold to TrueCar users who have visited their TrueCar certified dealer. And there are over 11,000 TrueCar certified dealers nationwide, so it's probably pretty easy to find one near you. And check this, for a new car, average TrueCar users save $3,279 off MSRP. All right, so you're probably wondering, how do I do this? It's easy. Just go to TrueCar.com or, right there on your phone, download the TrueCar app. You can find the car you want, see the TrueCar pricing curve, which shows you what other people in your area paid for the same car, and that way you can know you're getting a good price and feel confident. Then you'll get a guaranteed savings certificate from the TrueCar certified dealer. Go to the dealer, and your guaranteed savings off MSRP will be honored, and you enjoy a quick, easy experience. How's that for car buying? So when you're ready to buy a new car, or even a used one, visit TrueCar.com or download the TrueCar app and enjoy the better car buying experience. Some features are not available in all states.
I'm so glad you've joined us on the Clank Howard Show, because on this show we learn together. We empower each other with knowledge so we can make better decisions about our money. Our web address, Clark.com. When you have a question for me, Clark.com/ask. There's an area of Clark.com which has remained popular all through the years. It's our message boards, where we help each other through collective wisdom, questions about real estate or travel or cars, insurance, so many different areas of your wallet. But we have an oddball message board that you reach through the community section on Clark.com that's called Clark Stinks. It's when you feel that I have given bad guidance, bad advice, have a bad opinion, or just have rocks in my head. So you can post how you feel at Clark Stinks. Others can see what you posted, add to it, disagree with it, agree with it emphatically, whatever. And then once a week, our executive producer, Krista, goes through your posts on Clark Stinks, and she reads them right here for you on the air.
I should have never encouraged you to speak.
You must think I'm pretty stupid.
You should be ashamed of yourself.
Well, maybe I'm wrong. Maybe I'm wrong.
Maybe you're right, pal.
All right. Let's let some people tell you how they feel, Clark. Here's the first one. Clark, this mandatory retirement saving idea of yours stinks. Why does government have to be a part of your solution? What business is it of government's if, when, or how people retire? And don't tell me the idea is justified by the imminent failure of Social Security. I'm quite sure our ancestors figured out how to get by just fine before Social Security was implemented, just as modern-day and future elderly citizens will do in the absence of a government program. The programs we are having with Social Security, whose FICA premium started out as 2% of income, has grown to 12.4% presently, and is all but guaranteed to keep climbing in the future, stem from little other than a mass addiction to government. And being that government has made such a mess of the idea of retirement, I find it impossible to imagine that government is going to be part of a constructive solution. I think we fix this problem by laying off the pain meds we're addicted to, not by trying to Hail Mary a new pharmaceutical recipe.
Okay, that could not be a more timely post if you tried, Krista. Because
I didn't write it, just saying.
Who wrote it?
They didn't. I only read it if they signed.
What is this with the anonymous? Come on.
They have a username, but some people put
there.
their real first name there, and some don't.
So I have been a strong advocate for a generation for what Chile did. Chile came up with a program where instead of it being a government program like our Social Security, that you would pay into your own private account. They have had massive street demonstrations that have driven the popularity of the president of Chile down to 11% approval rating. Because what's happened is the program's been in place long enough, and people would intend to contribute but didn't. And the whole thing was designed that you would contribute 10% of your pay, your employer would contribute 10%. Well, people kept finding out ways to wiggle out of putting the money aside. Now they're hitting retirement age. They have no money saved. And what are the Chileans demonstrating for? And what do they want? They want a government bailout for the government to go back to having a Social Security system like we have and so many other countries have. So the thing is, if you don't make the savings mandatory, then the popular will becomes, well, then government will fix it. That's why I think the idea I have had that you have to have mandatory savings that go into private accounts that you control, and they're your accounts, is better than having mandatory money that comes out of your hands that goes into a government IOU that often, in most countries, is not properly funded.
Clark, you stink more than a rebloomed, self-wicking golf shirt worn by a fat guy riding the New York subway on a hot summer day.
I love that!
Did you tell a caller to pay $40 to do a Social Security benefit strategy analysis? There are several websites out there that provide good estimates for planning purposes for free. And they link to an article from a simple Google search that gives several options. Dang, Clark, $40. She was many years away from having to make a decision. She just wanted to get an idea. And you tell her to spend $40? Face it, Clark, you phoned that one in.
I did not phone that one in. By the way, as you know, I just don't like those wicking shirts because they end up with a real stank.
You want to read that again, Clark? You stink more than a rebloomed, self-wicking golf shirt worn by a fat guy riding in the New York City subway on a hot summer day.
Yeah, those shirts stink even if it's not hot. Anyway, so the Maximize My Social Security that I've talked about, it's because it uses such a complicated such a extreme formula to take the complicated situation of each individual or couple to help you figure out exactly the right answer for yourself. It's $40 for a couple, or if you're alone, $40 for you, for the license to be able to run the software, the maximizing software. But yes, there are many other options, including one I mentioned from AARP. Do you remember the Clark Stinks you had? Because I mentioned the Social Security Analyzer from AARP.
I do. Actually, this poster mentioned that one as one to look at.
Because we have people who hate AARP, and so somebody was upset with me that I mentioned using their free tool to analyze Social Security. So, yes, there are many that are available that are at no cost, and I will say this. We should put, with the information we have at Clark.com, the free choices, as well as this one you pay $40 for. How about that?
Sounds great. Clark, your recent response about whether to buy pet insurance was mostly right on, but there's one factor you overlooked. I totally agree that you should never buy insurance for something you can afford to cover yourself. For example, I never buy the extended warranty offered when I buy electronics, say a TV. However, when my TV gets sick and is about to die, I usually don't get very emotional about it. I don't mind having to make a life or death decision about the TV based strictly on the economics. But when my dog gets sick, I would hate to be put in the position of deciding whether or not to save the dog's life based on the financial hardship it may cause me. So here's a new suggestion. Consider getting insurance for the things you give names to, even though it might not be strictly economically necessary. Now, if you're someone who names your TVs, maybe this doesn't apply to you.
Thank you. I appreciate that post.
Dear Clark, periodically when you get really excited about a deal or someone saving money, you let loose one of your Tony the Tiger Frosted Flakes. Great! I find this jarring. No doubt you eat dollar store generic Frosted Flakes, not the real thing, so I shouldn't be thinking of a name brand cereal when you talk about a deal. But please consider saying cheap but not as delicious instead of great. Then at least I'll have the right image in mind. Thanks, Peter.
Thank you, Peter.
All right.
I don't know. I get so excited about deals. Bill Handel at KFI that I do an appearance with where we do something called Deal of the Week.
Los Angeles, California.
Los Angeles, yeah. Bill Handel says, it's really funny. He says, come on, let's hear it. Let's hear it. You're the most excited you've ever been about a deal right now.
Crazy
I pretty
Eddie.
much am like that about deals, yeah.
Crazy Eddie. Okay. Clark, what's the deal with you recommending everyone refinance their mortgage? You get so excited about the low interest rates these days, you seem to have forgotten refinancing a mortgage is not free. It's actually far from it, especially for lower balance mortgages. I couldn't believe it when you recently told a caller she should refi her mortgage that she only had 8 years left to pay on and roll into her newly refinanced loan approximately $54K in student loans for her children that she was only paying 4% on. Clark seemed to think she could refi in the high twos. No way. If you refi your mortgage and take more money out than you owe on your existing mortgage loan, the rate goes up, even if you still have equity in the house to cover the additionally financed balance. The lenders see taking an additional sum as an added risk, and they increase the interest rate accordingly. This means that the caller probably would not save that much, if any, in interest, and she would pay a large fee in closing costs to combine the loans, so would very likely end up paying more in the long run for her house and those pesky student loans that she never should have taken out on her children's behalf in the first place. Clark, you should have suggested that she and her husband suffer the consequence of the poor decision they made by signing for those loans in the first place and tighten their belt a little and start paying more than $360 a month.
I struggled with that call. While I was in that call, I was struggling with it. First of all, on the cash out, it is true that lenders look at a cash out of any significant amount of money as a heightened risk, and historically statistics show that you're in a greater position to potentially face a foreclosure. In her case, she had so much equity in the home that would not be a factor. She was wheezing financially, and it seemed that in her case, it did make some amount of sense to go into a 15-year loan to replace her remaining 8, which I hate for people going into debt longer, but she was really struggling, and I felt it would give her some breathing room in her life. And that one has a lot of gray to it. So our poster may be right that I did miss the mark on that call.
Clark, I've had to keep my car windows down all week because it still smells in there after hearing this massive stinker while listening to your podcast. A woman called asking about PMI insurance on a home mortgage, and you recommended that one possibility is to take out a 401k loan to get her up to the 20% needed to avoid having to carry a PMI. This advice stinks on so many levels. Let me count the ways. 1, you failed to warn her that if she loses her job, the balance becomes due within 60 days. Otherwise, taxes and penalties kick in. 2, most 401k plans freeze your ability to contribute to the 401k while the loan is active. You will lose any company match during that time, and it also limits your ability to realize market gains, which sabotage your future. And 3, when the caller made the comment about paying the loan back in one lump sum, you agreed. That is also incorrect. 401k loans generally have terms set from 1 to 5 years, and at least with my employer, you cannot prepay the loan back early, but must make the payments on the established schedule. This keeps you locked out of contributing to the 401k in the entire time the loan is active. And then they say the 401k loan should only be used in a dire emergency. And Clark, I hope you change your views on this issue and never give that kind of advice out again. John in New Jersey.
John, I must apologize. I don't remember the specific circumstances of that call. I am always nervous about recommending anybody. That's the second time I've said nervous during this. Always nervous about anybody borrowing from a 401k for most any purpose. And the individual, I'm guessing, because I shouldn't even guess because I don't remember the exact circumstances of the call, but only in a situation where they would be close to the 20% equity, would I recommend, if they had no other source of funds, doing a little borrowing from the 401k.
And Clark, you smell great, but your marital advice stinks like wet socks. A gentleman called in concerned that his wife joined a business where she sells skincare products. You said that the fee to join the business is small. That may be true, but the cost comes from the subscription-based education programs you're pushed to join to learn how to be a business owner and the monthly and yearly conferences you're expected to attend and shamed into if you don't. People who join these businesses as independent contractors might be better served by learning how to invest wisely in the stock market.
But I never want to harm somebody's entrepreneurial spirit. She will likely, as happens with most multi-levels, she'll likely within 90 days say this isn't for her. And if she had called me, we could have talked it through. I didn't want her husband saying, oh, this is a bad idea, honey, you shouldn't do it. I never want to take somebody who's got that spark and put it out before they've even had a chance to really run with it. I want to hear from you. Please go to Clark.com, go to our community section, go to Clark Stinks, and let me know where you feel like I've come up short. And there were many great suggestions today. Anne Marie is with us on the Clank Howard Show. How are you?
I'm doing great. It's good to talk to you. Thanks for taking my call.
Good to talk to you. How can I be of service to you?
I have a great opportunity. My friend moved to Norway, and they'll be there for 3 years. And I'm a stay-at-home mom now, so really I can go at any time. And we are on a budget, so just want to get advice from you on when would be the best time to go. I can't search for flight prices without having a date.
Well, that is true, but I just got to tell you, there have been some absolutely fantastic deals to Norway. A lot of the markets on Norwegian are under $500 round trip. Our producer, Joel, is of Norwegian heritage, and I've always made fun of him that he's never gone to Norway to visit his relatives there.
His groom's cake was a Norwegian flag.
That's right.
So Joel is going because of these ultra cheap fares. And what are you paying round trip to go to Norway?
Emily and I paid $536 per ticket round trip.
And they're going in peak summer. So with Norwegian, you're going to have to buy a domestic ticket out of San Antonio to get to one of their departure points. But the fare combination is low enough that it is a much, much better deal than historically we have to Scandinavia.
Okay, so I don't have to go when it's freezing cold. You
do not have to go when it's freezing cold. My mother-in-law and father-in-law are going because of these ultra-cheap Norwegian airfares. They're going to Copenhagen, Stockholm, and Oslo, and they're paying, I think it's $535 round trip, somewhere around that. So,
this is great. Okay, and what do you think would be too far out then?
Can only, generally with airlines, you can only book 11 months ahead.
Okay. Well, we'll try to get that booked then. Thank you so much.
Just keep watching the website, Norwegian.com.
Okay.
And you will love Norway.
They love it there.
And where are they in? Are they in Oslo itself, or where are they?
No, they're in Stavanger.
Okay.
I said that right.
All right. Well, Western Norway is magnificent. And that's why you want to go in a good weather time of year, which is not that many months. You want to go in a good weather time of year so you can experience the breathtaking beauty that the country has.
Stay tuned for 60 seconds of AP News headlines right after this podcast.
Welcome to the Clank Howard Show, where it's all about you learning ways to save more and spend less, and don't let anybody ever rip you off. Our web address, Clark.com. When you have a question for me, Clark.com/ask. We in the United States in this campaign year have heard so much about foreign trade, and Americans pretty divided about how they feel about foreign trade. But one of the byproducts of all the goods that move around the globe are these shipping containers that are these heavy metal things that only make one-way trips, because it's too difficult logistically. Once one has crossed the ocean, coming here to the United States or going from here to somewhere else in the world, generally nobody can figure out how to get new goods into those things, and they're just abandoned. In the United States, at every port, we have untold tens, hundreds of thousands of these things just sitting there unloved, stacked in weeded fields. And for years, people have thought, hey, this is a great way for affordable solutions, as an example, to housing. It's been something that I have glommed onto. Every time I've ever seen any story about it, I've really read it in full detail. And now I'm excited to report that a developer and a number of architects in Houston have come up with very attractive housing that they can build very affordably, houses about 1,200 square feet, using these shipping containers. The houses in the front look like craftsman-style homes. The shipping containers are very easily well insulated, and people get a rock-solid home at a very, very good price. There's a Houston company that I read about in the Houston Chronicle that is called Build-A-Box. Cute name. And so they take these trailers and they use them in a variety of formations to build different style looking houses, one from another. And I love it. You know, we have a housing affordability problem in the United States and a housing availability problem at the entry-level price point. This is something that I've been so into for decades as a volunteer with Habitat for Humanity. And I love what Habitat has been able to do in so many communities around the country. And Habitat does great work. But think about the efficiency. If we could use these unloved shipping containers and convert them, because the conversion is not difficult, into housing and create affordable communities. So with America and with the problems we face, whatever they are, I know rhetoric gets overheated and people get disappointed, but I'm telling you that we as Americans have the ability to take the problems we face and come up with constructive, creative solutions. And for you, if you have an entrepreneurial spirit and a creative mind, there are business opportunities that sit inside each of the major problems we face in this country. Because the ultimate solutions come not from government, but come from creative, energetic, innovative, and gutsy fellow Americans. Ben is with us. Hello, Ben.
Hey,
how are you doing, Ben?
Pretty good, although I'm going to get something that's going to contribute to my sedentary lifestyle. I was interested in getting a computer.
Oh, that doesn't have to make you sedentary. You know, I have a computer desk that sits over my treadmill, and I walk on the treadmill while I'm on the computer.
Hey, I was thinking of hooking it up to my TV so I could maybe run in place while I watch videos on YouTube or something.
I like it.
But I was wondering, where's the best place to get a computer from? Is it from one of the big box chain stores, or is it directly from the computer company online?
Well, as far as direct from the company online, Dell is really the last player still big into that.
Okay.
So I will tell you there is a chain that has a lot of locations around the country that tends to sell the lowest cost laptops in the country. And it's called, I don't know if you've ever heard of them, they're called Micro Center.
No, but I was actually looking for a desktop computer.
Oh.
I don't know if that makes a difference.
No, I don't think it does. It's just laptops right now are so unloved that you can buy a really full-featured laptop for about $250.
Okay.
For a desktop, you're going to find that desktops are there's so few of them made and available now that this is a complete reversal of what it used to be. A desktop tends to be more money than a lot of the laptops because they're looked at as productivity machines. They'll tend to have bigger monitors now and maybe oversized keyboards. And the desktops start at like $500, where the laptops start at $250.
Okay. So yeah, I'll look into that. What was it called? Micro Center?
Micro Center. I think they're from California, but they have locations. Let's see, what states are they in? Yeah, of course, California, Colorado, Georgia, Illinois, Kansas, Massachusetts, Maryland, Michigan, Minnesota, Missouri, New Jersey, New York, Ohio. I mean, they're pretty spread out around the country.
That's cool.
And I don't know how they do these prices. I guess they sell the computers so cheap, hoping you'll then buy other things from them, accessories and peripherals. But they often are the lowest price in any market they're in.
And you're still totally against buying additional warranties from, like, if Micro Center were to offer one?
Yes, I think that the extended warranties are a waste of money. You know, if you were buying a laptop, laptops have a greater break rate than other electronics simply because we drop them.
Yeah.
But many times the extended warranties, extended service contracts are not no fault. They'll say, oh, well, we think you damaged this yourself or you dropped it or whatever, and it's not covered. But even if it was, the reliability of these machines is so high now, and the payout on extended warranties on electronics is a fraction of a dollar, like maybe 6-8 cents on each dollar you pay in comes back. So it's a really bad bet.
Okay.
And if you spend a small enough amount of money, who cares?
That's true. All right. Well, thank you, Clark.
Okay. Good luck shopping.
All right. Bye.
Bye. Okay. I know I'm going to foul up your name, but I'm going to try it. Wekorga?
Yeah, this is Wekor.
Okay. Wekor. All right. Welcome to the Clank Howard Show. How can I serve you?
Yeah, thank you, Clark, for taking my call.
Sure.
I've been a member of Clarkonomics for some time now, and I enjoy your show. And thank you for giving that service. But my question is that I have employer-sponsored 401k where I'm contributing 10%. But I want to open Roth IRA and keep 6% in my employer-sponsored 401k and transfer the 4% into the Roth. I want to see what you think about it.
If you have the discipline to do it, I like it because of this reason. You'll have a pre-tax pile of retirement money and a post-tax pile of retirement money. By having money in the employer plan and having money in your own plan, the Roth, you've already paid tax on the money, so it grows tax-free, it's spent tax-free. The 401k is pre-tax money, so you get a tax benefit putting the money in. But then in retirement, everything's taxed. The beauty of having the Roth pile and the 401k pile is that when you get to retirement, it gives you more flexibility depending on your situation, what your tax rate is in a year, which pile you take the money from. Where if you have only 401k money or you have only Roth money, you lose some of that flexibility. So do you have an employer match where you work on the 401k?
Yes, I do.
And at 6%, do you pick up the max of the employer match?
That's correct.
Okay, yeah. So cutting back to 6 there, taking the other 4, putting in a Roth, I like it.
Okay, thank you so much, Clark.
Okay, and you know what else I love? You're saving a dime of every dollar you make, and when you take 4% and save it in the Roth, do you know that you'll actually be saving more money than you do now?
I didn't know that.
Because in your 401k, it's pre-tax dollars, and the Roth, it's post-tax. So you're actually going to effectively take more money out of your pocket and be saving more money than you do right now, which will really have you smiling way down the road when you go to spend money. Mick is with us on the Clank Howard Show. Hi, Mick.
Hi, Howard.
How are you doing?
I'm doing well today, thank you.
So you got a question for me about what you need to hold on to and what you should dump. What kind of things are we talking about?
Well, actually, I had a comment. I was listening to your program a few weeks ago. There was a lady that needed to sell her home. She was moving from this home, and you gave her advice on which bills to keep, and you advised her there was no need to keep the old electric bills. And I realize the context in which you gave her that advice, but my comment is that that's good advice only if the bills are high. If you're selling, if the bills are lower than norm, it can be a great selling tool, especially like if you're using as an ace in a hole to close a sale, say with a serious prospect. And later on, I'm 65, so I've bought a couple of houses, and I'd read this book on how to avoid the 10 biggest home buying traps is where I first read this. If you're a buyer, it's always a good idea, you know, if you find a house you think you might be interested in making an offer, is to ask the seller to look at the old electric bills. You can always call them the local electric company, but you know, it's good if the homeowner can produce those electric bills and you can actually look, and maybe if you know in the particular area whether they tend to be above the norm or perhaps below.
All right, you are so smart, because you know what you made me think about immediately when you brought that up. The last property I sold, the buyer actually asked to see the electric bills. And I didn't have them. And so I was able to go on the website of the power provider and pull up the bills for the prospective buyer. And it was something that helped with the sale of the home when they saw how low my power bills were. So
yeah, exactly. That's a perfect example of where it can help.
Well, I appreciate that, and that is good advice. If you've got a good story to tell when you're going to sell a home, that your home is efficient enough with either the appliances and heating and air conditioning system, or that you have it insulated well, that you've got a great storyline, definitely make your power bills part of that story. Mike, you're worried that you decided it was time for the golf course too early in life.
Well, I'm not so worried as much as I either feel guilty or maybe I did make the wrong decision.
Tell me what you did.
I was a 33-year government employee, and I retired with a pension. I am just 55. I just retired, and we also have a little bit of money from an accident with my wife.
She okay?
She is fine.
Oh, good.
A little bit of issues, but she's okay. I'm like the only person I know this age, and I do hear it on your broadcast over and over again to keep working as late as possible.
But you may not need to. All right, so were you a federal, state, or local employee?
Local.
All right, so you have a pension that replaced what percent of your income that you were receiving when you were working?
A little over 50%.
All right.
And I took
that scares me a little bit.
An accelerated payout till 62, and then it's actually dropped it a little bit. Actually, it brought me up a little higher to a little over 50%, and then it will drop back down to about 30% or so at 62.
So you'll have 30% of what your pay was, plus Social Security taking that benefit at age 62.
Right.
And have you reached a point in your lives where you and your wife have no debts?
Correct.
Okay. I think that it would be worth your while. You will not affect your pension at all from now till 62 if you pick up some work somewhere, will it?
No.
I would think while you're still in great health that there'd be real benefit to you working at least part-time somewhere for the next 7 years.
Okay.
Because if the math is as you described, I'm worried that later in retirement years, you could find yourself without enough money to live on and maybe not be physically in a position at that point to work.
Sure.
If you had told me you retired, as some government employees do, with a pension that is 70% or above what you were making when you were working, I'd relax more. But at 50%, it's going to drop to 30%. I would like you to build up some nest egg over the next 7 years.
But with the Social Security at 62, which I'm planning on taking, I will be closer to 60%, say, of my...
Yeah, I still think that leaves a gap that could come back to haunt you later.
We do have savings that we're kind of been offsetting the difference with, and that
is exactly the core of what my worry is.
Well,
is that the dollar loses value over time, the purchasing power of it.
Right.
That I would love it if you just maybe to an excess of caution, why don't you take a year off, retire for a year even, and then at some point a year from now, when you're 56, you pick up some part-time work to supplement so that you don't have to erode your savings. You build up more of a nest egg to carry you, because you could live to be 90, 95. When I was at the doctor, there was a 96-year-old woman there. Who knows how much longer she's going to live? You got to be prepared that you don't outlive your money.
Thanks for listening to the Clark Howard Podcast. Download new episodes every Monday through Friday at podcastone.com. That's podcastone.com. Stay tuned for the latest AP News headlines from Podcast One right after this.
AP Update, I'm Jackie Quinn. The sound of an earthquake victim crying in Amatrice, Italy, a tiny hilltop community devastated by Tuesday's eruption. AP correspondent Nicole Winfield reports that there is even more damage today from an aftershock.
The damage that forced the closure of one of the key access bridges came from an aftershock Friday morning, just after dawn. The U.S. Geological Service put it at a magnitude of 4.7. It was felt across the area and provoking new cracks in some of the damaged buildings and forcing the closure of roads.
It's been 2 days since anyone was found alive in the rubble. Rescuers are becoming pessimistic. At least 281 people are known dead, including the son of a provincial police officer who's been honored at a basilica. Funerals are getting underway Saturday, which is an official day of mourning. AP Update. I'm Jackie Quinn.